Happy Thursday and happy hour, everybody. Thank you guys for spending time with me tonight. I am thrilled to be here with you. It is Thursday evening, June 16th, 2022. And I'm just excited to be live with you guys. So I'm hoping you are either home and able to enjoy whatever you would normally enjoy for your happy hour cocktail. And if you are not home, hopefully you're on your way. I am actually enjoying a rye on the rocks from a place right here in Colts Neck, the Colts Neck Stillhouse. So if you guys have never tried Muckley Eye or the Colts Neck Stillhouse, definitely give this a shot. No sponsorship, no promotion. So I just really like it. So today on our happy hour live, this should be somewhere between a 30 and 45 minute. I think we might run a little bit long. We are going to cover some information that I find extremely valuable to you guys. We did this a couple weeks ago and we did it on a Saturday. I'm anxious to see if it's better today because we're doing it on a Thursday night. So first, before anything else, please let me know where you guys are watching from. I would love to know if we have people from outside New Jersey, outside New York, and the tri-state area. So drop that in the comments, whether it's on YouTube or Facebook or LinkedIn, which are the three places that we're live right now. And last time I have to apologize, those comments were actually not coming into my dashboard, so I didn't see them. So if that happens again tonight, I apologize. Please make sure for keeping those comments coming, and I'll get to you guys after the broadcast. Anyway, so what this is serving to do, if you saw the thumbnail that we put up, which was Panic in New Jersey, we're going to cover some really important topics that transpired in New Jersey this week, some news articles related to real estate, some news articles unrelated to real estate, and also the big conversation, right? What happened with mortgage rates this week? What are people doing? Is the real estate market crashing? Should you be buying right now? Should you completely pull the plug on the purchase you're doing? If you're a seller, should you pull out of the market? Should you be putting your place on the market? So we're going to go through all of that. Neil, how you doing, buddy? Good to see you. Neil from not just New Jersey, but a Colts Neck buddy of ours. So thank you for watching. What's up, Neil? I remember your first live. I think it was Ham Live that we were watching. I'm not quite sure what it was, but I think it was on like Thanksgiving Eve. So we're going to cover some topics. We're going to go through the real estate information from this week. And then at the tail end of this, we have a very, very special guest. It doesn't matter whether you're a real estate agent or if you're a buyer or seller in the market. We are going to be meeting with Scott Einbinder, who is a mentor of mine. And he's going to be bringing us through a class action lawsuit that's going on across the country right now that will dramatically change the face of the way real estate is done as a buyer, as a seller, as a real estate agent in not just New Jersey, in the country, if it passes in one way, shape, or form or another. So we shall see exactly what that means, and he's going to join us later. So let's get right into the news from this week. We're going to start off. I'm going to share my screen here with you guys. We are going to get into the first piece of news, which is talking about what's going on at the mega parcel at Fort Monmouth. So I'm not sure if you guys know exactly what this means, but Netflix made a bid this week, and you might have heard about this probably about 6 months ago as well. Let's back up to what Fort Monmouth is. So Fort Monmouth was a military base that existed here in Monmouth County, and it kind of sits on the border of three different towns: Oceanport, Tinton Falls, and Eatontown, excuse me. And in 2011, the Pentagon came back and said that they wanted to shut down bases across the country. 6 years after phasing that project out, the base was empty, and they had to figure out a redevelopment program of what to do with that space. So if you've been there, if you've visited it, it's a huge redevelopment project that's happening in this part of New Jersey. And if you know New Jersey, as far as the number of people that are moving out of the state versus the number of people moving into it, this is a big attractor to get people to stay in the state of New Jersey and to physically come to this part of Monmouth County. There's Fort Monmouth Athletic Club, which is on there right now. It's actually where I go to get physical therapy for Velocity Chiropractic. So check them out. But there's housing, there's mixed use, there's retail space on there, and it's nowhere near completed. Okay, so we got through that. This is the mega parcel. So of the 1,200 acres that exist on this property across those three towns, there's a 289 acre tract called the mega parcel. And about 6 to 8 months ago, there had been rumors that Netflix, the one you think about, had been eyeing this up to potentially put a production studio on it. Now, this is huge information because a national giant like Netflix or an international giant like that, bringing production to this area, the jobs it will create, the housing opportunities that will create is tremendous for Monmouth County and New Jersey as a whole. So Governor Murphy was behind trying to put this out to some production companies, and Netflix supposedly bid on it. Kind of went quiet. We didn't hear anything for a while. It was never a confirmed bid that was happening on it. And then this week, bids were due on that mega parcel. And we finally have confirmation. This is an article from NJ.com from Brianna Kudish that we have confirmation that Netflix did bid on this project. And they're one of a few different bidders. Another interesting bidder on this project, believe it or not, is Xtel. So if you don't know who Xtel is, they develop all over the country. They do a ton of developing in New York City, high-rise residential buildings. And here, they're notorious for the fact that they built out Pier Village. So the new lofts of Pier Village that you've seen us talk about and sell a lot of units in there, they're the ones that developed that project in conjunction with the Kushner companies. So they have bid on that in addition to, as you see here, Mega Parcel Development Company, RDR Partners, Russo Development, Donalo Development, and River Development Equity. So it's interesting. It will be interesting to see exactly what happens with this. But should Netflix end up winning the bid for that, that could mean tremendous things for this area because of the production opportunities and the jobs that that will create. So before I go any further with that, let's show you what that parcel actually looks like. Let me make sure that you can actually see what I am sharing with you as well. So we're going to go back here to the tab about the mega parcel. Here you go. So this, like I said, it's about 1,200 acres, the entirety of the fort. And the part in Eatontown is a little bit more separated from where this parcel is. So that's where Sunny Eagles golf course is, and they're developing some townhouses and condos over there. This is the 289-acre mega parcel. So just so you guys have a bearing of where that is, and you can see the line down the middle here of the difference where the property line for the township between Eatontown and Oceanport. So the next part of this is, why is this happening? Why is Netflix even interested in this? And that has to do with not just Netflix, but a couple different companies that have been eyeing up production studios within the tri-state area. So again, I'm just getting to understand how exactly to switch back and forth between these. So I promise you I will get better at this. But there's an article that came out on Real Deal, which is an industry inside online publication, about New York Plus, which I guess Jersey is New York Plus. It's better than being the armpit of New York, which is how people have called us, or what they've called us for many decades. But there are a lot of production studios now that are looking for places to create more content within the close proximity to New York. So why do you need to be within close proximity to New York? Obviously, there's a lot of people, celebrities, actors, actresses that are already there, and this becomes a hop, skip, and a jump for them right outside the city. It's easily accessible because of Newark, JFK, and LaGuardia airports to get to Jersey as well. And the space, which you can't find in Manhattan, is here. Typically something we don't have a lot of in New Jersey, but we do in this situation. So there's been an increase in the number of studios like the Lionsgate project elsewhere that are looking for studio space. And why does this happen? Quite honestly, because of what you guys are doing right now, which is watching me streaming on YouTube. We are all consuming so much content through streams, whether that's Netflix, Amazon Prime, Hulu, whatever it is. They need more space to create more shows, and they need the ability to create them, which gives them the space here in Jersey potentially. So that's a very interesting project to keep an eye on. Okay, so Neil says Easter. Oh, that was the last time you did it. Got it. So let's move on to the next topic. And if you guys have questions about Netflix, drop them in the comments down below, whether you're on Facebook, YouTube, or LinkedIn. We're going to be doing some deeper dives into the information as it comes out about this. Who wins the bid, exactly what their plans are with the project, to keep an eye on it, because obviously it has dire implications, not just on us here in Monmouth County, but on all of us here in New Jersey from a property ownership perspective. All right. So next that I want to get through with you guys is talking about something that's going on again this week in Long Branch. So if you guys heard anything on the news, I guess it was about 2 weeks ago, there was this party that popped up in Long Branch at the Pier Village lofts and in front of Pier Village proper, which is the older section of it. There was a party that was organized to be put together across social media on TikTok, and it became a disaster. I'm not going to weigh in. I don't have a feeling on any of it. All I want to bring up to you is what is actually happening as a result of that. And there was some information that dropped yesterday within Long Branch. So party at the shore. This is an NJ.com article. And here we go up to the top. Pop-up or crackdown. So this was posted on TikTok. Massive amounts of people came down, got off the train, got off the bus, drove their own selves there. And then a ton of people ended up in Pier Village. And then chaos ensued. The cops were involved. It was a mess. A lot of people actually felt unsafe. There were people locked in restaurants. There were people locked in buildings. I'm bringing this up because we do quite a good amount of business in Long Branch at the Pure Village lofts, and obviously, even with some of the other projects that are going on in that section of Long Branch, property owners want to make sure that their values are protected, because if more of these parties happen and there's chaos and there's arrests and people get hurt, there may be a public incentive or a public desire not to want to buy there or to devalue those properties. So I'm very interested to see what happens. Hit a comment down below if you guys have an opinion on this. Does what's happening over in Pure Village affect your opinion of what the values are in that area? Would you not buy there as a result of what you've seen happening? But the article itself gets into a meeting that transpired at the township this week where they are trying to sue the organizers of that meeting or the organizers of that party. Now, nothing has come of this. And the reason why that's important is that there is another one planned for this coming weekend. So I'm putting you guys on notice. If you plan to be in Pure Village, either Sunday or Monday, because Monday is a holiday, remember, just beware, because supposedly there's another party going on there this weekend. And I want everybody who's a friend of mine and just in general to please be safe. So keep an eye out for that, because that is absolutely something that is supposed to happen. Obviously, the township is more prepared for it now. They have a bigger police presence, but that situation alone cost the township of Long Branch about $24,000 in overtime just of the police force to come in and take care of that event, in addition to all the other stuff that happened and people being put at risk on both sides. So just be safe, but I'm interested to see what you have to say about whether or not this changes your opinion of the value of those properties. All right. Next, I'm interested to see, does this actually switch back and forth if I change which article I'm sharing? I don't think it does. So I'm going to pop over and do this again a different way. The next part of this is talking about, I'm just catching myself here, so thank you guys for bearing with me for a second. I think that's all the main articles we actually wanted to get through about New Jersey. So let's talk about the big one, right? Let's talk about the panic. Mortgage rates hit 6.3%. Everybody freaked out. The world is ending. Nobody wants to buy a house anymore. It's chaos, right? Well, I want to get into why that happened. I want to get into what that actually means for the market. I want to get into possibly the bad things that means for the market in not a way that you're actually thinking about. Scott is actually in the green room too, so he's going to hang around with us. But let's talk about it in layman's terms, right? We have 30 people watching this right now. I probably have 8 to 10 of you that are either in finance or that are in mortgages. So I promise you, I'm not going to do as good a job of this as you will. But if you've been watching us on social media for the last couple of years with video, you've heard us talk about the federal funds rate, how that's tied to bonds, how bonds are tied to mortgages. We're not going to get super deep into that, but I am going to explain this to you in layman's terms, what this actually means to you. So we are facing an environment with unbelievable inflation right now. Everyone understands that. You know, from going to fill your tank up in your car, what the cost of all your goods and the cost of gas is. They're through the roof. Everything has become less affordable. In addition to that, we've had a run up in real estate somewhere around 35% since the beginning of COVID until now. Rates have been historically low for an extremely long period of time, including at the beginning of COVID, where they were in the 2s, under 3%. But since the beginning of this year, rates have doubled. They've gone from the mid 3s to 6.3% this week. Now, how does this tie into what's happening in the stock market? Because again, you've seen the NASDAQ, and I was very acutely aware of the fact that the NASDAQ is down 30% from people correcting me on Facebook this week, not 25%. But if you've looked at Bitcoin, if you've looked at your stock portfolio, you've seen everything is down dramatically, not just over the last 6 months, but in the past week and a half alone. So the Fed is doing what they can do to try to stem inflation. And usually what they're doing in that situation is trying to raise the federal funds rate. The federal funds rate obviously affects bonds, and bonds usually affect what happens in mortgages. But there's an incorrect correlation from the public that says that because the federal funds rate goes up 0.75 or 75 basis points, mortgage rates should go up 75 basis points. And that's not necessarily the way that it works. And what confused people yesterday was the Fed came out, the Fed Chairman Powell came out and said, we are going to raise it 75 basis points. And then rates actually went down. They decreased from 6.3% the day before to, I think, where they are today is around 6%. So still high, but not at the peak of where they were. And they didn't get worse. So people are like, well, how does that make sense? If the Fed fund rate goes up, why aren't mortgage rates going even higher? And the reason for that is by the time the Fed makes their announcement, the market has priced in what the expectation of that Fed funds rate going up or down is. And it, yes, went up 75 basis points, but Chairman Powell actually said something that gave the market confidence, which was that although they are going to raise it 75 basis points, and they may do it again in the next quarter to go up 50 or 75 basis points, they don't necessarily believe that 75 basis point increases are needed too much farther into the future. So that makes people think, okay, maybe we're not headed into a interest rate environment in mortgages specifically where we're going to see 8, 9, 10, 12%. Just stop there for a second. 12% interest rates for a mortgage. You're probably thinking that's not possible. No, it would never happen. It did happen. It happened in the 80s. Talk to your parents. If you're my age, I'm 42. Talk to your parents and ask them what interest rates were when they bought their house in the 80s. Interest rates were over 12% in the 80s. But, and yes, people were still buying houses. Real estate agents still made money. People sold houses. But what people don't know is that in order to sell a house in that market, because there was a ton of inventory and you had to be the one that sold if you really wanted to go, you had to offer points to buy down somebody's mortgage in order to get them to pick your house versus the other one. So you might pay down 1, 2, 3 points or more on someone's mortgage, meaning that you're decreasing the rate that they're paying essentially by contributing at closing to the amount of money of their mortgage. I am bringing this up to you today because as you are a buyer here in this market right now at 6% interest rates, is it painful? Absolutely. If you are a seller, is it affecting your ability to sell your house in this market? Absolutely. Where we were 3 weeks ago, 6 weeks ago is a totally different place than where we are right now. And the reason I'm bringing up buy downs is I believe you are going to see these enter the market again for savvy sellers and savvy real estate agents that want to move a property in an environment where people are cautious about the rates going up. You are going to see, and we will be implementing this as well, you're going to see sellers who are offering to buy down your mortgage. And if you are a good buyer's agent or a good buyer, you can be asking for the seller to contribute to buying down your mortgage if you're not willing to do it yourself. I'm not going to get deeply into exactly what the technicalities of how you do that is on this video. We will do a follow-up video about that for sure. But some of the creative financing options that existed in the downturn of the market back 2009 when the market crashed through 2012, you are going to see some of that enter the market for the savvy, for the smart, for the quickly reacting people. So assumable mortgages, another topic we're going to talk about, which is where you can technically assume the mortgage from the current person because their rate was lower. Can't really do those in conventional financing, but FHA loans with some stipulations can be assumable mortgages. So you're going to, as a buyer and a seller, you need to educate yourself on some of these creative financing options that are out there. Now, Neil seems to be the only person I can see the comments for. So hopefully you guys are commenting on Facebook and I just can't see them. And I promise you, I'll get back to you either on YouTube, Facebook, or LinkedIn. But I am interested to hear from you. If you're watching this video right now, I have 2 questions. Actually, I have 3 questions. 1, if you've been a buyer and you haven't bought a house recently, but you're in the market, what are you doing right now? Are you stopping the idea that you want to purchase? Have you paused? Are you still moving straight forward, pushing ahead? Drop a comment down below because I want to see what you have to say. Number 2, if you're a seller, what are you doing? If you've been thinking about putting your house on the market and you haven't done it, are you pulling back now or are you actually pushing forward and getting the house on the market as quickly as you possibly can? And number 3 is if you own a home currently and you're not in the market to buy or sell, could you afford your house right now if you were buying it all over again, still at the price you paid for it, but with a 6% interest rate? Just sit here and think about that for a little bit. You can run the math on it after we're off the video, but I'm very curious for people to sort of digest that information. All right. So we're at 6% interest rates. We've had 35% appreciation year over year. We've had bidding wars like crazy. COVID forced so many people to want to move because their needs in a house and where they wanted to live was completely different. Where the hell are we headed? And are we headed into a crash is really the question that everybody wants to know. I am not a gypsy. I am not a fortune teller. I don't have a crystal ball. We look at the data. We read as much as we possibly can. And I have my own ideas of where we're headed. I do not see us heading into a vast decrease in property values. And I know that that's shocking. And I know there's people who are going to disagree with me. And I would love for you to share that feedback with me so I can see it as well. Let's see if I can actually see any more of these comments, which I don't think. I know that may not be everyone's opinion on this, but here's the rationale behind it, okay? Interest rates don't change markets from a seller's market to a buyer's market. They can slow it down, right? They can change the number of buyers in the pool. But what changes a market is supply and demand. And what we've been having for the last 2 years, why we've been in this dramatic seller's market, is a dramatic lack of inventory. More people wanted to buy than there were homes available to sell them. Hence, property appreciation, 10, 20% year over year. Hence, bidding wars, over asking price offers. Now, interest rates will pull a certain number of buyers out of the pool, but it doesn't fix the inventory problem. That doesn't bring more houses on the market. And here's my concern. I am actually worried that with interest rates where they are in the sixes, and I don't think we're not going to see them go, I should say that differently. I do think you're going to see 7% interest rates. That actually is going to hurt inventory, in my opinion. I think that's going to cause this problem to get worse. As a seller, myself, if I wanted to move right now, I could get a great number for my house. I know I could. I've got equity. I've got profit here. But if I'm going to move to the next house, regardless of what it's priced at, I'm going to go from my current 3.75% interest rate that we have when we bought this house to a 6% interest rate. How badly do I really want to move? Only the motivated will actually make that move, because otherwise you're moving to a more expensive, just based on rate, mortgage if you need a mortgage. If you're a cash buyer, obviously this doesn't weigh into the equation whatsoever. But how many sellers are sitting on equity right now that want to sell but will not sell now because they're going to be moving to a more expensive interest rate, and that inventory will remain locked up? On top of that, I don't know how much you guys have paid attention to this, but there's been massive purchases across the country from iBuyer programs, most notably Zillow's that fell flat on its face, but BlackRock and other hedge funds that have been buying properties above market value for the last not just 2 years, but 3 and 4 years. They have every expectation of never bringing those homes to the market. They are buying them as a new investment asset class. They are keeping them as rentals forever. If with that inventory not coming to market, on top of the number of sellers that now don't want to move, you are still going to, in my opinion, have a dramatic drop in inventory, or at least not an increase of inventory on the market. Now, as the number of buyer pool drops down and the inventory stays where it is, we'll get to a stable market. I think we will get to a place where we're not seeing over asking price offers, and you're not selling a house in the opening weekend. It might take you 3 weeks to a month to find that person, but you will still be able to sell a house. You will still be able to buy a house. And my suggestion to you as a buyer right now is, obviously, if you're a cash buyer, pay cash. It doesn't make sense to go ahead and do a mortgage right now. And in the recent history, it did make sense to take out a mortgage because it was 3% interest rates. Right now, I don't think it actually makes sense to do so. But if you are a buyer who needs to take out a mortgage on the purchase of the property, I would suggest you actually go look at something called a 15-year ARM. And again, I am not a mortgage professional. I'm just giving you my recommendations from some of the research we've done for our own clients and the mortgage professionals that we work with and trust. A 15-year ARM, and you might have heard of a 5-year ARM, a 7-year ARM, a 10-year ARM, is an adjustable rate mortgage. But the number before that is how many years that mortgage is fixed at a rate until it goes to an adjustable. Now, if you plan on being in a house for 25 years, obviously your motivation on how long you want a fixed rate for changes. But if you're not going to be in the house for 15 years, take out a shorter term mortgage like a 7-year ARM. The average rate for people who are staying in their houses before COVID was 7 years on average, that we would live in a house before we would move to another house. With COVID, that jumped almost to 12 years because people couldn't move. People didn't want to move. We've had a lot of people change, but now they're staying a longer period of time. So it's interesting to see that dynamic on the number of years people are staying in a house. But even if you're going to stay for 12 years, a 15-year ARM, which is a product that not many people know about, not many people have utilized, could be a great vehicle for you. It means that you're going to get a mortgage rate that's fixed for the first 15 years of it, and then it will go to an adjustable rate after that. So what's the advantage of doing that? Well, typically a 15-year ARM will be, what I've been seeing this week, is almost a full percentage point lower than what a 30-year fixed rate is. You're going to have a lower mortgage payment. You can pay it off sooner. And in all reality, if mortgage rates drop, let's say that you got a 15-year ARM right now at 5.5%, which I don't even know if that's 100% accurate, but if you're at 6.3% for a 30-year fixed, you're probably 5.25 to 5.5 on a 15-year ARM. When rates drop again in the future below 5.5%, you can refinance out of that loan into a lower 30-year fixed if you really wanted to. So my question to you, and this is what we've been sharing with our own buyers, I'm thankful that there's still a bunch of you hanging around as I got into really dorky information about mortgages and interest rates. But what I've been asking people who are sitting on the fence and going, I don't really want to buy right now. This is like the worst time. I'm going to be buying at the peak and the market's going to crash. Okay, let's assume it does. 10%? Is that what you think is going to happen? We were down 20 plus percent in the recession, 2007 to 2012. Nobody sees that coming. Most people don't see a 10% pullback coming. If there's a 10% pullback in pricing, that savings you have of the house going down 10%, right? A $700,000 house goes down in value, $70,000. That savings to you about buying a house 10% less next year, the year after, when that 10% drop happens, is completely wiped out by a 1% increase in your interest rate. So my question to people is, what do you think is more likely to happen over the next year? A 1% raise in interest rates or a 10% drop in pricing on houses? I will take my bet on the interest rates because it happened this week alone. We went up a full percentage point basically in the last week and a half. So what this means is you should be buying right now if you need to buy. Your perspective is everything. Your timing is everything. If you need a bigger house, if you're motivated to move up to the next house, if you're moving out of a rental, you need to buy. You should not be stopping that process. You still should be buying because real estate over the long haul continues to go up in value. And you can refinance out of a high rate to a lower rate when that happens. I understand it's obviously less affordable to do so right now. When you're not at a 3.5% interest rate, you're at a 6% interest rate. But that's our opinion on it. So I'm interested to see if anybody else has a differing opinion on this. All right. It is almost 6:30. Scott has been patiently waiting for us here. So I am going to add him to the stream. Hey, Scott, how are you?
Hey, how are you?
I am very well, thanks. So for those of you who don't know Scott, I have to give you a proper introduction.
Okay. I better hold on for dear life.
Yeah, watch out. You might want to duck out for a few minutes. So Scott is, well, first off, let's give him a formal introduction. Scott Einbinder. Scott Einbinder is the president of the Einbinder Consulting Group. But informally, Scott is a real estate consultant. He is the mentor that I had in the beginning of this business that really taught me all the secrets, the tricks, the knowledge that I needed to become the real estate agent I am today. And I'm not just blowing smoke. This was truly, I felt like other real estate agents had some sort of secret potion that they were able to sell a house with. And when I finally worked with Scott, I was able to sort of remove the fog and the veil and kind of see how this business really operated. So I'm always eternally grateful to you for being my mentor, not just in the beginning, but ongoing.
Well, thank you.
But Scott basically grew up in the business. His family has owned brokerages. He's been in real estate since he was in diapers. And he consults for real estate brokerages, real estate agents as well. And the reason why I have him on here today is there's a class action lawsuit that's happening across the country right now. And I'm really going to hand the mic over to Scott in a minute, that will affect buyers, sellers, real estate agents. And when I saw a post about him or from him this week, talking about it, or last week, my antenna really went up because I've been hearing about this in the background, but it was sort of like something I was not really paying attention to and I really needed to. And I want you guys to know about it as well. It hasn't come to fruition yet, but you need to have it on your radar. So I'm going to hand it over to Scott.
All right. Well, thank you, DJ. And thank you for those kind words. But let me tell you something. You were a very, very easy student to work with. You know, it was really been a pleasure. So let's just jump right into it. You know, when you had when we spoke about it a little bit and talked about, you know, this lawsuit and you didn't really know much about it, believe me, that's not something that's surprising to me. I bounce around. And I'm in real estate offices literally every day. You can, see me on social media. You see I'm always somewhere. And I am just really shocked how many agents and broker owners and managers are just not aware of what this litigation is all about and how it could really impact their business. Why that is the case, I don't really know. I know that if we rewind the clock back to the early days of Zillow entering into the space, I was always surprised how many realtors never even heard of Zillow back in the day. They didn't even know what that impact was going to be. Remember, there was a litigation, that Zillow participated in order to make the MLS data transparent to the consumer, and it was fought by the industry, and it was not embraced. So, like most major litigation in our industry, for some reason, it just remains silent until it becomes a factor and everybody's scrambling. So good for you for getting on the front of the curve of this. So let me just kind of give an overview of what this is. for many years, the industry has been under kind of a spotlight of how commissions are allocated. And for literally 50 years in this business, 60, 70 years in the business, the way commissions are allocated between buyer agents and listing agents has pretty much remained unchanged, and if we kind of do a little bit of a history lesson regarding commissions and regarding how it's done, this whole concept of charging a seller a commission of X% and sharing that commission with a buyer agent comes from a very prehistoric time in our industry. It was before Realtor.com. It was before, Zillow. It was before internet. It was before Wi-Fi. It
Back
was
when you used to have to walk into a brokerage and they'd open up a book to show you properties.
A buyer had to call an agent and say, "Are there any homes for sale in Cold Spring, New Jersey?" And an agent had to go do some research and call them back. It was very, very archaic in how things were done, but it was the way it was. Let's fast forward to 2022. It's really pretty much still done the same way, right? We charge a seller a commission of X, and the concept is the reality is that this commission is shared. So in essence, the seller and the listing agent agree to a form of compensation. They agree to a percentage, and then the listing agent offers out a percentage, let's just call it 50%. It doesn't have to be 50%. It can be any split thereof. But they offer out this commission to a buyer's agent. And for decades, and in many circles still is called an incentive, meaning we give buyer agents an incentive to bring their buyers. Now, whenever I hear that word incentive, it always kind of makes my blood pressure go up a couple of points, because according to the code of ethics, I always thought that there can never be an incentive, meaning that the code of ethics say that a real estate agent, a buyer's agent, the commission should never be the reason for inclusion or exclusion to bring the property to the buyer. But let's leave that on the table for a second. Forget the incentive. Basically, the percentage offered out is a form of compensation, right? So when you really think about it, and when you really think about this lawsuit and the litigation and what it's all about, and I'll go into detail, for 50 years, for 60, for 75 years, as long as it's been doing it, the listing agent has been the person to negotiate the compensation for a buyer's agent, right? So you could be a terrible buyer's agent, horrible, terrible responsive time, terrible. But you know what? You get paid.
Talking about me, right?
Not talking about you, but you get paid your compensation because the listing agent negotiated on your behalf. Okay. So over the years, and what transparency to our data has done, and as we all know, buyers, when it comes to the quote unquote value of a buyer's agent, we know that that's changing. And again, this topic, it gets agents very, very angry. It shouldn't, but it does. We all know that the buyer habit is changing, and more buyers are going directly to listing agents. Buyers are searching online. They're bypassing the buyer's agent. They're going directly to. And so one could make the argument, and I'm not here to make the argument, that the value of a buyer's agent is changing. Remember, for 50 years, one of the values of a buyer's agent was to find the house for me. Well, we all know that, realtors don't really find buyers' houses. Buyers find the houses, and realtors bring them to the houses that the buyers want to go see. So it's a complete inversion of how things really are. But let's understand what this is. So the lawsuit is designed, and who are the plaintiffs and who are the defendants? Well, there's a couple of lawsuits. There was one lawsuit. It was Leader versus NAR. In Leader versus NAR, which was based out of the Illinois market, it was a lawsuit on compensation on commissions. And basically the lawsuit, the Mahler versus NAR, which is another one, there's two, is basically this. A listing agent who is presenting themselves to a seller, and a seller who will now be paying compensation. The seller will only be paying the compensation that is going to the person whom they're hiring, which is the listing agent. So a listing agent, should the lawsuit succeed, and again, there could be all ultimate variations of how it ultimately gets settled out, but this is what it is in a general sense. If you're a listing agent, the only compensation that you're going to be negotiating, asking for, collecting is your side of the transaction. So if you were, let's say, a 6% agency and you were keeping 3 and putting out 3 in a hypothetical situation, you would simply just be charging your 3, collecting your 3, and that's it. So now the seller will no longer be responsible to absorb the buyer side of the commission transaction. So buyer agents, what are they going to do? Well, if the lawsuit succeeds and it pans out as they think it will, a buyer agent will now have to negotiate their compensation directly with the buyer. So when you think about it, who does the buyer agent work for? The buyer.
Right.
Who does the buyer agent represent? The buyer. Who's delivering the service to who? To the buyer. And so when you kind of think about it, it will now be incumbent upon a buyer agent to be able to articulate their value and collect their commission accordance with what value they're able to sell to their buyer. Okay. So now the buyer will come to closing with down payment, closing costs, and realtor commission. Now, just a couple more things and we can discuss
before I jump off and start
couple things.
Asking questions.
One of the things that some agents think is, well, Scott, no big deal. No big deal. All we'll do is we'll up the price and we'll get the money kicked back to us that way. Can't do it. Lawsuits looking to prohibit that. So there's going to be no inflating of the price. There's going to be no embedding it in a seller concession. And all the theoretical and kind of perspectives that people have in which they're going to try to be able to kind of do an end around, it's not going to be allowable if the lawsuit succeeds. So what you're going to be left with is an industry where listing agents will articulate their compensation accordingly and provide value and be hired by the seller for the services that they're bringing to provide. And a buyer agent will, in essence, have to do the same thing. Now, what this sets up is, and what we need to understand and realize, we all know, even without this lawsuit, that more and more buyers are going directly to listing agents. We hear it all the time. And by the way, every real estate agent loves that. They call it a double-ended trend. Everyone loves that.
I don't. I actually hate it because I always end up in a sticky wicket.
I gotcha. And you're not alone. There are agents who don't like that. However, DJ, I would tell you that if you properly school the buyer and seller and bring them both full transparency and you work with full disclosure, you can successfully navigate those things, provided you go through the proper, transparent conversation with both sides and set the expectations accordingly. It can be done, and it can be done correctly. Now, the reality is that we know buyers are doing this more and more. They're going directly to listing agents. Everyone will tell you that. But now, if the lawsuit succeeds, buyers might just have another reason, and another level of motivation, because now they're going to be faced with an agent saying, listen, I'd love to show you houses on Sunday. However, I charge 2%, 2.5%, 3%, whatever it is. That's $12,000, $15,000, depending on what the price range is. And the buyer's going to have to now make a decision.
Yeah.
And what
that's where I jump in, right? That's my question is.
And they might say, and then I'm going to let you jump in. They might say, well, you know what? Let me go shop out buyer agents based on commission, which they've never done before, which they might do. Or they might say, you know what? I wonder what the listing agent's going to charge. What if I contact the listing agent directly? And we know that listing agents who are already receiving their compensation on the seller side might have more flexibility. Not that I'm saying they should, but they might have a little more flexibility to ultimately do it for less. And what's the purpose of the lawsuit? The lawsuit had a purpose. It was to lower commissions to the public. That's the reason. That was the purpose of the lawsuit. And by the way, the DOJ has participated in this. They're very interested in this process because if it succeeds, my question number one is, will sellers end up paying lower commissions? Probably. Will buyers end up paying lower commissions? Probably. And then the lawsuits will succeed. So that's what it kind of looks like. And now I think, let's open it up for discussion on, how do you pivot? How do you adapt? And how do you work with it?
Well, that's my question, right? So I got a million questions as a result of this. But as a real estate agent sitting here who's listening to this for the first time, if there are people listening to this, or should they be panicking that, oh my God, I'm going to lose half the income that I'm actually making in this industry?
Right. So here's my view on that. I think that change is always good. And I think that any industry, whether it's real estate or any industry that has any type of barrier, it should always be let the best survive, because the best who remain in this business, the beneficiary is the client and the consumer. So I think that And we all know that the real estate industry for 50 years, or as long as it's been going, is one of the industries that has what we call the highest failure rate out there. We know that 85% of agents who get their license are out of the industry within a couple of years. And we know that there's a lot of people in the business who are part-time, poorly trained, aren't committed. So what I think might happen, and I don't really know, nobody is a guru, and even analysts, we don't know. But I think that it might cause the buyer side end of our business, the buyer agency side of the business, to have a retraction, because now if you're a buyer's agent and you don't have any ability to articulate your value and articulate your compensation, and you can't justify it. Let's face it, if you can't justify your compensation, if you can't deliver it to a consumer in a way that gets them to understand that, hey, are you really worth $12,000? What am I getting for the $15,000? Remember, it's been kind of embedded. Even though buyers were paying it, maybe inside of the price or in some way you can always kind of trail it back. Now it has to be justified, which in my view is a good thing. Because if I'm a buyer's agent and I now have to justify my value, now I better start giving more value in order to substantiate my compensation. So
For sure. I think this is an unbelievable timing for something like this to be discussed as well, amidst the conversation we had before you joined us, right? Yeah. We're in an environment where rates are changing, prices are all the way up. People are panicking about whether they can even afford to do this. And now all of a sudden, as a buyer, let's say this passed in 2023, you're telling me I got to pay more money out of my own pocket on top of my closing costs, on top of my interest rate, on top of my purchase of the house. I have to come with more cash. I would think, like you're saying, there's going to be obviously some people who say, I appreciate the agent that I'm working with, and they really are bringing me value because they're identifying properties that are not on the MLS. They're finding me sellers that are not actually on the market. But
we know in the off-market world, DJ, one could make a pretty good argument that if I am a house hunter for you to find off-market properties, there's, I think, certainly some value there. But we all know that 99% are all on-market properties, right? The off-market world is a very tiny world. And I don't think that that's going to represent any kind of scale of justifying value for finding off-market properties. I think that we're looking at more justification of what an agent does to bring value on the on-market properties. And again, that's where things will be subject to, I think, significant change.
So we've got a couple comments coming through on social media. I'm going to put a couple things up here. So Mike Verlaku, who is a mortgage professional, actually said, do you think you're going to see the listing side of the business move to a 4% and 5%? So not just the overall commission for both agents, but just the listing.
I particularly think it's an excellent question. And I think that the value add that listing agents need to create to bring more value to their sellers will get better. And I do think that this is a bonanza opportunity for great listing agents because, again, I think listing agents have a different skill set than buyer agents. Generally speaking, listing agents have to go out and create their own opportunity and create their own business. Generally, buyer agents, they're coming to you. I mean, they're generally contacting you. So I think that it does provide a environment where, and I don't necessarily have to tag it to 4 or 5. I do think, though, that the ability to charge a premium commission to a seller does increase. Not because of the elimination of lots of agents that may not be in the business, but I think that as we go into markets where we have more normalization, I think sellers need more things from listing agents. And I think listing agents have to change. If you're a listing agent and all you have in your bag of tricks are MLS, open house, broker open, videos, photos, market reports, mailers, social media platforms. I mean, most real estate listing agents, DJ, not you, have the exact same package no matter who you go to and who you list with. I mean, I'm inside of every single brand, and I can tell you there's very little variance and deviation from one broker to another, one agent to another. However, if you are an agent who can infuse new value-added services to sellers and clients, I think that sky's the limit on what your compensation can be.
So just in general, disruption, which sounds like this is what this will be, is generally good for any market, right? Any industry disruption. Look at what Uber did for taxis. So
what it did for taxis. How about what it did for consumers, right?
Yeah. Yep. Absolutely. By the way, I have a wife who's headed down to Florida tomorrow for a family emergency she needs to take care of, and she doesn't know how to use Uber. So if anybody on here wants to message Nikki and let her know it's the simplest thing you could possibly do, she needs to know how to use Uber.
Well, what somebody should do is send an Uber for her, so she doesn't have to do anything.
Damn. That's me. That's absolutely my bad. We're not even thinking about that. I want to put another comment up here too. So Laura Cowan, who, full disclosure, is a past client of ours that we helped on the buyer side of the business, said, actually, let's put her first comment.
Sure.
So I couldn't have survived without a buyer's agent so willing to talk terms, but realize the value. So that's a very interesting comment from her.
Right.
What about agents who are both buyer and seller agents? So
under the current state of the world, if you're a realtor, if you're part of the MLS, there's a limitation. Basically, it says that you can't get compensation from both sides, right? If I'm a listing agent, I can't earn a commission from a seller. I can't earn a commission from a buyer at the same time.
Right.
One of the proposals inside of the litigation is to change that. And what that means is that I would represent the seller in a fiduciary capacity, which, full disclosure, and then I would represent the buyer in a non-fiduciary capacity.
Okay, I need to stop you right there, because this is actually one of the questions that I asked you that I want to bring up, because I think there are other agents on here that are probably thinking the same thing. You're going, okay, I listed the house. My commission that I worked out because of my value was 4%. Let's just say that's what it was to the listing clients.
Right.
Now, buyers are coming and they want to make offers on the property that I'm listing for sale. They choose not to work with a buyer's agent. They're coming directly to me as a listing agent. I now am back in that situation of disclosed dual agency. So I, as a listing agent right now, let's just remove myself from the situation. The one thing that always is tricky is disclosed dual agency to both people. And it sounds to me like this litigation is actually pushing people more to that situation, that they're going to have to work in a disclosed dual agency situation. But you're telling me it's not that way.
Actually, in most other states in the country, dual agency is actually illegal. This is taking place in New Jersey. I'm sure people are watching from somewhere else, but most other states are non-dual agency states. I mean, New Jersey, New York, we have the exception to the rule where we actually can represent both sides. Now, when you think about it, the reason why it's illegal in most states is it's not really practical, right? How can you represent both sides with the same level of interests and fiduciary? So part of the litigation is to change that, meaning that dual agency will, in essence, and New Jersey will, in essence, adapt into the way it's done in most other states, where you only have a fiduciary to one party and you have a non-fiduciary to the other party. And as you know, what transaction brokerage is there's no fiduciary whatsoever. Now, what's interesting is that if the lawsuit succeeds, and again, how it will ultimately play out is going to be in question, but part of the proposal is that as a listing agent, you will be able to represent your seller with a fiduciary.
Right.
You will be able to represent a buyer in a non-fiduciary and earn compensation from both sides. So this will open the door for listing agents to have lots of flexibility with how they want to deal with the buyer side compensation of the transaction. There are some people who talk about buyer agents ultimately becoming just buyer delivery services, where it will take on a different complexion, and listing agents will earn their compensation as they deem negotiated, and the buying agent process will be a little bit different. Now, in other states where there are non-fiduciary relationships with buyer agents and buyers seem to have not had a big problem with it. It doesn't seem like buyers push for fiduciary. They seem to want to get to the property. They seem to want to get access.
Right.
They seem to want to have a good negotiator on their behalf. They seem to want to have somebody who can help them with the process. But at the end of the day, the fiduciary thing hasn't appeared to be a major need that buyers are seeking. They want the buyer agent for different things. So this is part of the evolution of the business. Remember, buyers have tremendous access to information that they did not have when we used to have this high fiduciary buyer interaction. Remember, they were very reliant on the buyer agent for almost everything. Today, we have such transparency that the value of that, to some degree, in my opinion, has kind of dissipated a little bit. So again, I don't want to get into the discussion, which I'm happy to do at another time. Value of buyer agents, value of buyer agency, where's the value really there? But this is just what's shaking out. And again, the big picture reason and why the DOJ is so intimately involved here is there is a perspective on the part of these plaintiffs and the government that the real estate industry has artificially kept things high, and they work with each other in a particular way to kind of make it hard for there to be price competition. And that's kind of what the essence of it's all about. One could argue that, when you really think about it, should a seller have to pay for a buyer agent who's representing a buyer? I mean, that's an interesting conversation when you really think about it. And I think that we can, can take.
So I'm gonna pose another question to you, because my mind just starts racing with this, given the business that we're running and the way that our business is structured. And this is something we have to realistically sit down and brainstorm and strategize about, especially if whether it goes through in exactly as it's planned or some iteration thereof, it will change the industry. But my question is, okay, I'm a listing agent. I've listed a property for sale. I have my listing side fee. And now it is a market like it was for the last 2 years, and buyers are coming, and there's multiple offers on the property. And now there's 5 other buyers that have come to make offers on this property who do not want to hire their own buyer's agent. They want to come to me as a listing agent, where you said that I have a fiduciary to the seller. I have a non-fiduciary to the buyer. How would you play that situation out? How would you handle that for those 5 buyers?
EJ, one of the biggest evolutions of our industry has been the evolving of the team inside of brokerages. Teams are a evolution of our business, right? Back in the day, there weren't really teams, but what is a team? A team in real estate today is a business within a business. It's a brokerage within a brokerage, right? The broker themselves brings a certain value to the equation today, but then you're left with teams, team leaders. Team leaders are usually listing agents, and teams usually consist of buyer agents that float around the team leader. And the way I think it's going to shake out is that the buyer side of the team will play more of a role in the interaction and communication of the transaction of the process. And again, as long as there's great transparency between the buyer and the team, and there's full disclosure, and things are running at a place, and you're dealing with integrity, and that exists, I do believe that it can be navigated successfully, provided there is that transparent communication along the way. Remember, buyers aren't buying houses alone. They have attorneys, they have advisors. Buyers are not these lost souls sitting in a corner going, "What do I do?" Buyers have people in their camp as well. So, the argument can be made that the process can be effectuated with more simplicity, with more efficiency. Let's face it. When you've got a buyer agent, you got 2 companies, 2 people, 2 processes. One would make the argument that the efficiency of a real estate transaction has a lot to do with the amount of hands that are touching these things, Yeah. And if there's less hands on the, maybe it'll be better for consumers and better for clients. And I think at the end of the day, if the client wins first, and we're smart enough as agents to figure out ways to make money where clients do win first, your income potential is unlimited in this.
Well, I think that's what it always comes back to, right? Is those who succeed and those who are successful in any industry put the customer first. If it's a service-based industry, that's what you have to focus on.
There's an expression in our business called agent-centric. I'm sure we've all heard it. I loathe those words. I like consumer-centric. I like client-centric. And if you can run your business where it really is client-centric, it really is customer first, and you're smart enough to build your business around that experience, the one thing that you rarely see on social media are happy clients, right? You see realtors previewing their listings, talking about themselves. You don't see enough of just happy clients, happy customers. Right. How about them? Where are they?
They're out there, but we're more important, apparently, right?
I don't know.
That's the way it appears on social media, right?
I'm always mystified. I know agents, they just don't put their happy clients on there enough. Not that they don't have them, or maybe they don't have them. I don't know. I mean, they rely upon a Zillow review. I don't know who's reading today. I mean, everything is video. I mean, why aren't there video testimonials on every single closing you have where everyone's saying what a great experience it was? And some people will want to be on camera, some people won't. But I don't know. The one thing I just don't see enough of in this industry are happy customers.
That's a great Great
Don't see
piece
it.
of information to be shared. So I'm going to put you on the spot and ask you in relation to what you were in the green room listening to me talking about.
Yeah, sure.
Where do you think we're headed in the next 12 months with the industry? Do you think we're going to see a price drop? What do you think's happening?
Listen, back in March of 2020, DJ, I when things were starting to really get crazy, I sat on more analyst calls, and I would say 50 to 60% of analysts who were Ivy League educated, by the way, not that that has any bearing
You
on
better
you.
be careful because you know I am.
I know.
Don't smash
Ivy
it.
League educated Wharton School graduates who were predicting the collapse of the real estate market. This was in March of 2020.
Right.
The collapse. Values will be down 50%.
Right.
And we know what happened. So I think that there are so many unpredictable elements. The one thing I always tried to do is I say, you know what? And somebody, much, much smarter than me said to me, Scott, a good businessman doesn't try to guess tomorrow. They just try to have an accurate understanding of what's happening today.
Yeah.
And to me, I think that's really what's the thing here. I do believe, however, I'm already seeing it. Inventory levels are up, in markets. And again, this is a New Jersey-based conversation we're having now, but in Lakewood, North Dover, Toms River, some of the hottest places where we saw 100% appreciation rates in the past 2 years, we're seeing price reductions, major deal collapses. Inventory levels are up through the roof. Now, I don't know what tomorrow's going to bring, but it certainly appears that we are in and headed for a higher inventory environment. Now, if we just go back to Economist 101, we know, and as you said, supply and demand, the problem with most buyers is there were no homes to purchase.
Right.
Now we're going to see more availability of inventory. On the other side, buying power has dropped by 10, 15, 20%, meaning the $750,000 buyer is now a $550,000 buyer, right? Based upon the same mortgage payment. That being said, 6% interest rates, even 7% interest rates on a 30-year average is still pretty good. We're still 100 basis points below a 30-year average at 7%. So that being the case, I have optimism. I think that the availability of inventory is a good thing. I think that, remember, these 3% and 4% interest rates we've had for, I can't even remember for how long. They've been artificially suppressed. You had the Fed that was a very active buyer. We just got used to something. Even when I hear you say, or I hear you say, rates are up, rates are bad, it's not good. I have the reverse thing. Rates are unbelievable.
Right.
For you to be able to secure 30-year money for 6 or 7%, you should be thrilled.
Right.
It's not as good as it was. You weren't able to steal we're not able to steal from the candy store anymore. Okay, it's terrible. It's horrible. No, it's not. We're just getting back to kind of a normal way of doing things. And the good news is that most of the mortgages that people got over the past 7, 8, 9, 10 years, they could qualify for. So when you talk about the crash, you're talking about people who provided income documentation to afford their mortgage. The likelihood that they're going to abandon it like they did in the last mortgage crisis is probably pretty low, even if values do go down slightly. So, I don't know. I have a very different view. I think that this is a great, great time. I think that, I could have liked your thing with panic. I always say, who's panicking? You know what I mean? I know people that aren't panicking. I know people, me and a lot of people in my orbit, we're thrilled. Because there's more inventory, there's more opportunities to purchase. Rates are still amazing.
Right.
Mortgage companies are still giving money. I think the time to panic, DJ, is if you and I are sitting online waiting for a loaf of bread.
Yeah.
Or we start hearing bombs going off and it's not thunder. I think that this is a really good time. Listen, equity portfolios, yes, the market, what's happening, that's not good, but is it not good or is it good? Now things are cheaper. Now maybe the opportunity to buy. And by the way, all these reductions in values in stock markets only matter if you're a seller. Yeah. Somebody said to me today, Scott, do you think it's a mistake to buy a house right now? Because you know what? I'm afraid it's going to be worth, $100,000 less in 2 years. I go, are you selling 2 years?
Right.
If the answer is no, who cares?
If you're a seller in this market, that's the only way you actually lost money. Otherwise, if you hold on to it and wait for it to come back,
if you're a flipper right now, I don't know. It seems to me that's a little bit of a risky move. But if you're a buyer with a long-term hold, I don't know. Who knows? And We know rentals are good. Buying houses and getting the rental income, rental prices are great. New Jersey's a popular place to rent. You don't have to come up with these big down payments, but I can rent. So if you're an investor buying rental properties and you want the rental income, I don't know. I think it's a great time.
You brought up a very interesting point that I think people forgot that they were paying dramatic attention to in the first 4 months of the pandemic, right? This is off script, by the way. We did not talk about this. This is not on the schedule to talk about, but you can watch our videos from back 2 years ago. We were talking about when are the landlords who have people that their renters are squatting and they're not paying because they've been furloughed or they lost their jobs. When are those properties going to get foreclosed on? And you brought that up, and I want to just go into it for a second. Well, why would they get foreclosed on when they're up 25 to 35% in value? And the bank, if somebody decides to stop paying the mortgage, can go sell it for a profit. Right. So that shadow inventory that we saw with short sales and foreclosures during the recession, is that coming?
Well, for coming, it's here. I mean, you got to be living in a cave. If you're a real estate agent and you have not jumped into the short sale business, if you're not a short sale expert, if you have not embraced those opportunities, you don't need training. You need therapy and massive amounts of it. Crazy. These homes, there are thousands of people in pre-foreclosure, and not every single one of them is a short sale, of course, but there's a good amount in there. And what's the element that you need to do a short sale in a pre-foreclosure? You need a hardship. And I think we've come through probably a time where the word hardship is probably learned at the age of 2. So there are, if you're looking, I know realtors, they always, listen, agents said in the last 2 years, there's no inventory. Hold on a second. There's a ton of inventory. You just don't know where. Go to these people in pre-foreclosure, see if they can do a short sale. Some of these people aren't even a short sale based upon the increase of value.
That's what I'm saying. Are they really short sales or are they really equity sales at this point because the profits are there?
But short sales are tremendous listing opportunity. And you know what the funny part about it is, DJ? There's so little competition. I mean, I believe there's a very little competition in this business anyway. I mean, even though you have 100,000 realtors in New Jersey, most of them are doing things the exact same way and there's no differentiation. So you really have very little competition in the real estate business. Lots of people with a license, very few people who are competitors. So in the short sale world, even less.
Right.
And agents, they're just, again, and you know who I blame? I blame the broker. Your brokers, if you're listening, managers, you want to bring value to your agents, don't ask them to come to a short sale class. Force them to go to a short sale class. But Scott, they're an independent contractor. It doesn't matter.
Well, that's a whole other conversation about what the federal government's doing about independent contractor status. We'll save that for another day.
Listen, that's the nail in the coffin. If they all of a sudden flip that to a W-2, then you'll really see 1.3 million realtors go down to, I don't know, 50, 60.
Yeah, I'll be there, but I'll be standing, but nobody else will be with me.
How many brokers are going to pay their matching FICA to, the 140 people in the office who only come in for a Tuesday office meeting because they bring a good lunch? Not many.
I think that comment just went over the head of like 85% of our audience that's not a licensed real estate agent, and maybe the rest of them that are licensed real estate agents.
That would be a fun one.
All right. So before I let you run and I finish out the conversation, somebody's sitting here watching, they're a mortgage originator and they want to have you come talk to their office. Somebody who's a broker or an agent, they want to have you come. How do they find you? What do they need to contact you?
Listen, you just Google my name and you'll find me. I'm pretty easy to get a hold of. That's really it. I have, as DJ, I have a very different perspective on the business. I have a very different attitude on it. The clients I work with really are on the progressive side of the curve, not progressive for the sake of being different. But the one thing that I know, and I've known since I've been doing this, is that the consumer usually moves at a much faster clip than an industry. And I think a lot of agents are kind of lagging behind the consumer of what the consumer wants. So, my brand, what I do is I try to bring a different way of thinking, a different way of operating, a different way of executing, not because I just want to be different, but because, this seems to be what consumers break. I'm happy, the majority of my clients are in the top 1% of the industry. They do, they're platinum is like, normal, and that's really kind of what I'm into. I like working with that segment of the world because that's the world that always seems to want to do better. It's interesting. the top 20% of the business is always looking for new ways to improve, give me new ideas. It always seems that the bottom third doesn't want to be told, don't tell me what to do, I know what I'm doing. So, again, I think I like to reach for the top end, who have the ability to be introspective and bring evolution into their business, because the consumer is certainly doing it.
Well, thank you for joining us. I greatly appreciate the insight you brought, putting this on our radar. If you're a real estate agent out there and you missed the beginning part of this, make sure you go back and check out the YouTube, watch the whole section about Scott, reach out to him, and make sure you pay attention to the class action lawsuit and what's happening.
And for the record, DJ has no responsibility or liability to anything that I've said. He is immune. We give you a hold harmless to all of my comments.
You just made my wife super happy, who is our director of operations. She feels a lot better that you just.
There you go. So full disclosure, you are released from any and all liability from any of my comments.
Beautiful. I love it. Thank you, Scott. I appreciate it. Guys, stay on for a minute. Even after Scott leaves, we've got a couple extra things for you here. But Scott, thank you very much. I appreciate it.
My pleasure, DJ. Take care, man. Good seeing you. Take care.
All right, guys. Before you jump off, I actually missed something earlier that I really wanted to make sure we talked about. Two things, actually, and they are a little bit of self-promotion. So before I get into those, it's we're actively growing our YouTube channel. My kids laugh at me because I'm sitting here in the office doing this, and they're probably laughing at me downstairs in the kitchen. But this is an active part of our business. We're trying to reach you guys and want to know that we're making content that's important and valuable to you. So please make sure you subscribe to our YouTube channel. Make sure you get alerted when we drop new videos. The two little self-serving portions of information are that I am eternally grateful to the people who are on our team, who may not be on here today, but they are equally as important as I am. So Cree, Sabrina, John, Nikki, AJ, Lydia. Hopefully I'm not forgetting anybody, including Alicia, who is our transaction coordinator. Scott alluded to something called platinum and rankings and top 1% and all that stuff. And this is a very self-serving industry in a lot of ways. We were ranked number 10 in the entire state of New Jersey based on the business we did last year. I am eternally grateful to the agents on my team and to you guys who are our clients for letting us actually help you and assist you in the business we do. So thank you for that. Little humble brag to the rest of the team that's out there. The last part of this that I want to get to is a property that we have on the market right now. The person who's going to buy this property knows one of you, and I am out here to make sure I find that person. Yes, we have an offer on the property, but I want you guys to know about this. So let's see if I can find the Chrome tab about the property that I want you guys to know about. Literally 30 seconds. So thank you to Allison Prees for putting this article out on NJ.com, focusing on our property at 160 Hartshorn. This is a once in a lifetime piece of property, and that is not hyperbole. This property, the 10 people that I've showed have all said that they've been eyeballing this thing for 10, for 15, for 20 years. I've got people, Anthony Buffano, wonderful attorney here in Monmouth County, who said he used to take his boat as a kid across to the little cove on this property to fish. This is a 17-acre parcel that exists on the Navesink River that has the potential for subdivision. So yes, it is listed for $9 million. Yes, that's a lot of money, but the potential for subdivision, selling off, if you can get 3 lots out of it, you can get 2 lots out of it, build your dream home, and then be able to sell those lots for basically paying yourself back for what you paid for the main property, is a huge, huge value. So thank you to NJ.com for picking up and writing an article about the property. I hope you guys will share that. If you want a link to that, we'll make sure that that property link ends up in the YouTube description down below the video. And I think that is all we have. Unless you guys have any comments you want to drop below in the YouTube or LinkedIn before we finish up here, I am almost to the bottom of my drink. And I greatly appreciate you guys joining me. So let me know if Thursday night was a good time to do this. Let me know if you think we missed out on anything. And otherwise, thank you guys for joining me. Happy hour, happy Thursday. Have a good night.